Hi, my name is Justin Botillier, enrolled agent, owner of Rogue Tax Professionals. Today I got the question about the correct way to determine what a person's tax rate actually is. A lot of people think that they're making money, say they make $150,000 and they get over $151,000, then all of a sudden they're paying a higher tax rate. Well, that's not really the case. We get taxed on a certain amount up to a certain point, and then the tax rate goes up. So, for example, you might have a 10% tax rate from $1,000 to $50,000, and then a 15% tax rate that goes from $51,000 to $75,000, and then a 20% tax rate that goes from that 75. So it's kind of an accelerated or tiered tax rate. So it doesn't actually mean that if you're in the 20% tax bracket, you're paying 20% on all your income. That's not the way it works. And you can just Google the tax rates, and you'll see that it'll show that between 1 and 15,000 is 10%, and then the money that's you earn above and beyond that will be taxed at a higher rate, and then once you get past that threshold. So it's really kind of an average of all the tax rates and not necessarily just one tax rate. There's different kinds of tax rates. There's what's called your marginal tax rate, which is if you're 150,000, you might be in the 20-25% tax rate. So that would be your marginal tax rate. But really, the rate you want to look at is your effective tax rate. That is the actual tax that you owe, or your tax liability, compared to your adjusted gross income. So if you divide the tax that you owe, not including the money that you already paid in, but the tax that you owe in total before taxes withheld go towards that money, divided by your adjusted gross income, that's your effective rate. So you might find that you actually have a really low effective rate. And in the United States, I'm happy to say that we have a low tax rate federally, typically. Of course, there's big differences as to whether or not you're an employee or if you're a business owner. And sometimes you can live in a state with a high income tax rate as well, which contributes pretty heavily to your effective tax rate. That's really the tax rate that you want to be looking at. And again, to make it simple, what you do is you just find how much you owe before the money that you had paid in through your payroll or through estimated tax payments, divided by your adjusted gross income, and that's your effective rate. And you want to get that for federal and state in order to truly know where you're at.